Hey guys, Michael, I See Life. Welcome to the channel. Man, today I wanted to just share a video. I actually hopped on a Zoom or a video chat with my buddy Matty Ice. We got on and we were just breaking down a National Life Group IUL illustration. We basically broke this thing down page for page. A lot of golden nuggets, a lot of things that we found inside the illustration that most people never read. They don't know what's in their contract. And so we wanted to bring these things to light. We wanted to explain, hey, how does this contract actually work? Like, what's in the contract? What's in the writing? And so, yeah, it was basically, man, it was pretty much pure gold. Like I said, we broke the thing down page by page. I do have to give a disclosure. We almost broke the whole thing down. We went over the numbers and we kind of got excited, I guess, and we just left the last page out. The last page talks about the indexing strategies, who they're owned by, who manages them, and the fees that are associated with them. So we didn't get into the indexing cost or those fees, but don't worry, I'm gonna have another video coming out pretty soon where we go over the indexing strategies and the costs associated and how they work and just break those things down completely. So anyways, if you guys have an IUL or you guys are looking at an IUL, by the way, and you guys want your IUL or your illustration broken down basically in the same way so you can know everything that's in the contract, hey guys, feel free to reach out, feel free to send me a message, just get in contact directly, and I'd be happy to do a video. We break it down for free and give you all the information that you're looking for. Anyways, this one is for, like I said, National Life Group. So go ahead, like, subscribe, and enjoy.
All right. I love going live, man. This stuff is so much fun.
Oh yeah.
What's going on, my fellow wealth creators? Matty Ice here. We're going to have some fun today. Kind of a last minute video, but I was talking with my friend Michael here, also an agent at Life 180. And we were talking about IUL earlier. And what we want to do in this video is break down a real life IUL illustration. But before we do that, I want to say a couple of things. All right. First off, while I am not a very big fan of IUL, I would never tell somebody to never purchase an IUL. Can they be structured properly? Can they work out? Maybe, sure. But my biggest issue with IUL and why I really like doing videos like this is because I don't think that the majority of people know what they're actually buying when they're getting an IUL. I think, Michael, you'd probably agree with me on that. Like the way that IUL is illustrated, presented, and sold to people is absolutely nuts. It like borderline almost illegal, right?
Yeah.
And what I want to do with this video is show you guys, like, we're going to break down an actual IUL illustration that an agent sent to Michael. We're going to break it down and just kind of pick it apart. And like, we're going to talk about some of the fine print and just how these things actually work. Because until you know how they actually work, you can't make the best financial decision for yourself, right? If you don't know what you're actually putting your money into, that's a really big problem. You don't know that you're making the best decision for yourself. Like when you hear you get upside potential, downside protection in the market, and eventually you're going to get all this tax-free retirement income and all that stuff. It sounds really good, but what is actually happening underneath the surface? That's what I really want to break down in this video. And I'm really passionate about this, and it's one of the reasons I started this channel. And Michael, I think you'll agree with me on this, is that like I almost went down the path of purchasing an IUL. When I started going down the infinite banking rabbit hole, one of the first things that showed up was IUL. Like IUL this, IUL that. It's just this amazing unicorn financial product that's going to solve all our problems. It's just fantastic, right? And I almost purchased it, but being like just the conservative nature that I have with my money is like, okay, let me go a little bit further down this rabbit hole. Let me really understand how this product works. And that's when I found the other side of the conversation, talking about all the actual potential risk and all the things that can go wrong with IUL. That's when I was like, man, I thank my lucky stars every day that I did not purchase IUL, because it's absolutely not right for me. That's why I set up my dividend paying whole life insurance policy. And it's been amazing. I'm working on my second policy right now. And so part of my mission with this channel is just to bring the facts, bring the information about how these things work so that people can actually make the best decision for themselves. Because a lot of times people don't know what they're buying, right? So I just wanted to give a little bit of background on where I'm coming from this, why I'm so passionate about it. It's not that IUL is necessarily bad. When you learn how it works, you tend to run the other way, but maybe it's right for some people. That's fine. It's how it's illustrated, presented, and sold to people that I have the biggest problem with. And that's what we want to discuss today. So that's a little bit of background on me. Michael, if you want to take a few minutes, share, I would love to hear your background on this, how you got into it, what your experience with whole life IUL is, all that stuff. Go for it. Let's hear it.
Yeah, I was actually introduced to the life insurance industry through WFG. Fell in love with it really. But I was selling IUL for about 4 years. And then, I just kept diving deeper and deeper. I became considered an expert on IUL. People would come to my team, come to my agency so I can train them how to sell it, where to show them how the risks are, how to structure it, right? And then eventually what happened was I just started finding out too much. And I knew there was certain risk in the IUL. And I think it wasn't till I ran into Chris Kirkpatrick where I really understood the extent of that risk. And once I understood the extent, I realized that everything, what I was selling, like I had a problem if this was the case, if this was true, right? And so I actually went into a phase where I started researching. I started calling all the carriers like, hey, what other riders can we add? What other protections do we have? And so if I wasn't an IUL expert before, I just dove even that much deeper into it. And it came to a point where I just realized that it is what it is, right? And you're not going to get the guarantees. You're going to open yourself up for risk. And now that I understand the extent of it, I basically stopped selling IUL, strictly focused on whole life, especially for infinite banking, helping people take control of their money. Because ultimately that's what I was trying to do with IUL. I just didn't realize it was the wrong product.
Yeah, the wrong vehicle. Right.
Yeah.
That was, I mean, almost my exact type of experience when I started learning how it actually works. I was like, man, I don't want anything to do this. I'm curious, being someone that has sold IUL. I mean, you're much more familiar with IUL than I am. I think I've got a pretty good understanding of the basics, and that's why I ran away from it. Do you think there's like what scenario, what situation would an IUL actually be good for? I mean, assuming also that it's properly structured, max funded, etc. Is there any scenario where you would recommend an IUL to somebody?
So I haven't recommended it since I kind of came to the realization what I was selling. I did do a video, however, breaking down the components of IUL. If you look at it for two main reasons, right? So the first one is, the whole idea of this tax-free retirement. Mm-hmm. Would I buy IUL for tax-free retirement? Would I recommend it? No. The truth is there is no life insurance policy that you should be considering as your retirement vehicle, period. Not IUL, not whole life. Now, does it mean whole life can't be a strong financial tool and vehicle to help you reach your retirement goals? I mean, it absolutely can be, right? But it doesn't, your income should not be based off of that whole life policy either, right? So
sure,
I'm not discriminating. There's no life insurance policy that should be your retirement vehicle, period. Right. Sure. And that's one thing I figured out. The other thing, you're going to look at it from a death benefit standpoint. And so when you think of insurance, and it's the idea of, well, the definition of insurance is transferring risk, right? So if you're going to transfer risk, why would you transfer that risk into a policy where you're taking all the risk, right? All the variables are controlled by the insurance company. If they lapse your policy, they win, by the way. And that's another hard realization to have, is you're putting your money in a place where, it's going to grow, right? But there's all these levers and they control the levers. Mm-hmm. And if they don't have to pay out the death benefit, they're more profitable.
Sure.
So how much sense does it make to put your money at a place where the other side wins if you lose versus a win-win?
Right. And to kind of play devil's advocate, because I can already envision all the comments that we're going to get on this video, is that like there's a lot of protections that like different riders that you can add to the policy to help it prevent it from lapsing. Okay, let's say that's the case, but then you also that doesn't solve the problem for the fact that you illustrated all this income for somebody. They made plans around that illustration, assuming that they're going to have that income, and now they don't have it at 75, 80, whatever age that is. So, okay, maybe their policy didn't lapse because you had this life-saving rider, but now they don't have any of that income either, right? It's just gone. So that's a whole other issue. So maybe, the policy didn't lapse, but now they don't have the income that you told them that they were going to have. And that's an illustration problem. That's a conversation problem. And it's one of the biggest problems I have with IUL is showing. Maybe we can kind of transition to this side of it, and we'll. I'm pretty sure we're going to see this in the illustration that we're going to pull up. But it shows the crediting every single year as if it's a CD product, and it's being credited every year. And then you have the positive arbitrage when people are taking loans. When that doesn't happen, it quickly spirals out of control, and now people don't have the income that they want.
Right.
Am I crazy here?
No. So there's two riders that are geared to protect your policy from lapsing, right? So you have your no lapse protection rider. In this policy we're going to go over, it's actually a National Life Group IUL. It's a 10-year rider. So basically what that means is it's going to cover you for 10 years, make sure your policy doesn't lapse, as long as you're making a guaranteed premium amount, right? So you have to qualify it through a premium, but the reality is through making that premium, you're paying for all the cost in the policy. Your policy is not going to lapse in those first 10, 15 years anyway. So it varies by carrier. So really what you're doing is you're actually throwing away money because you're paying for a rider that you don't need anyway.
Right, because the issues don't really happen in the beginning years of the IUL. It's later on when people get older, they start taking income. That's when it can really get into trouble. Right.
And so the second rider is the overloan protection rider, which, if you guys don't understand, there's all this talk about it's tax-free. Well, the reality of it is it's tax deferred. So if this policy were to lapse, you would have a massive tax bill potentially on all the growth that has ever taken place, all the loans, all the compound interest, all of it. Right. So what they do is they give you an option. Most carriers it's 75. There are a couple carriers that are 65. And if you don't make it to that age, you're going to have a tax bill. So what this does is it stops the policy from lapsing. It's going to consider it as a paid up policy, just so it doesn't lapse. So all it does is it protects you from taxes, but you still have no money.
Right. You're right. You don't have the income anymore. And again, it's how it's illustrated. It's not necessarily a product for me. It's how it's illustrated. I had somebody show me an illustration on an IUL taking out $212,000 per year for life starting at 65. What? Are you kidding me? Oh my God. It was the craziest thing I've ever seen in my life. I would never make plans around that. So it's how it's illustrated, man. So I think, let's get into it, man. I want to see this illustration. And here's the thing too. This is the frustrating part as well, is like what I was mentioning earlier is, can these policies work? Maybe if they're structured properly, but how many are structured properly? It is absolutely crazy how many policies are not structured properly. I remember watching the interview that you did with a gentleman that sells IUL, and he did I think he said he did 400 policy reviews, and only 8 of them were set up properly. So it's like a 97-98% ratio of not IULs that are not structured properly. And these are already products that have so many things that can potentially go wrong. You don't know what the stock market's going to do, what cap rates are going to do, or whatever. And then you throw on the fact that it's not set up correctly. Oh my God, man. It's crazy how many are not set up correctly. So I'm really excited and just anxious to see how this thing is set up. So Why don't
Yeah.
go ahead and share your screen and we'll go ahead and pull this thing up.
Let me share with you real quick.
Yeah, go ahead.
I had another agent, a brand new agent. She just wanted me to basically test her upline and tell her what's wrong with the product. So the upline is basically trying to sell me this product, right? So I wanted the illustration just to see how she would structure it. So when it comes to properly structured, she told me this is properly structured. Now, the gentleman Brian, this is a policy that he would say is not properly structured. So number one,
that's who you did the interview with, right? Brian was the name?
Yeah,
gotcha. Yeah, that was good.
So, now it's like, okay, well, what is properly structured? Right. So obviously,
good question.
Two different people have two different answers to that. Because
Brian, and if you're the client and you don't know the difference, you're just going to assume that the person in front of you telling you that this is properly structured, you're going to believe them. 9 times out of 10, right?
Right.
And that's where people get into trouble.
And here's the other part. The whole idea of properly structured, it's a flawed concept, because the idea, even Brian, right, saying, hey, 97% of these are not properly structured, they're trash value, they're gonna lapse, you need only 3% are good, right? But the reality is this: if you have to qualify your product by saying, well, it's because it's not structured properly, it needs to be properly structured, then number one, as the IUL agent, you're admitting that there's an issue with the policy. Right? So you're admitting there's an issue. So your solution is, okay, well, let's structure it properly. But what does properly structured mean? In the whole life world, you do structure the policies. You add a term rider to it. You add PUA riders to it. So there's 3 parts to the policy. But in IULs, they're not adding these riders, right? It's just, you're just putting more money into the policy. So the structure is actually completely the same. It's not like it's a different structure. All the flaws are still there. It still works the same. All the levers are there. The structure is 100% the same. Even when they say properly structured. So nothing actually changed, right? It's what's really happening is you're just throwing more money at the problem.
Yeah.
Which, by the way, you admitted that there's a problem, or you wouldn't have to qualify it by saying properly structured. So you're throwing more money at this problem. And, would I agree that money solves problems sometimes? Yeah, of course, right? But sometimes it doesn't solve the problem. Sometimes it just becomes a money pit. If you ever had a car that you took to the mechanic, and then you take it back the next month or the next month, it's like, why don't you just get a different car?
Right. So, I agree.
Eventually. But yeah, let's get into it. This is what she showed me. It's a
while you're pulling that up, just a couple of things on that, because I have seen, I read what's his name, Elon Moaz's book, Lapsed. I just think everybody should read that book before you ever consider buying an IUL. In the cases where it was max funded, it seems to reduce the risk of the policy lapsing. But to your point, it still doesn't change the chassis that it's built on, which is annual renewable term, the fact that cap rates can adjust, participation rates. I was watching a video earlier where they were breaking down a real life IUL illustration in policy that was set up in 2008, and they looked at the performance from 2008 to 2020. I'm pretty sure it wasn't set up correctly, but they illustrated it 9.31% or something crazy. The net internal rate of return after all fees over the course of that time frame was just barely over 1%. That just boggles my mind. But when it comes to setting it up properly, does it potentially reduce risk? But yes, but there's all these other things that can potentially go wrong. He set the policy up when the cap rates were 15%, and then the cap rate went down to almost 6%. It's dude, that makes such a huge difference on somebody's policy, man. It's just nuts. So, anyways, just a couple of points on that. Can it, like I said in the beginning, can it work? Is there less risk when it's set up properly? Maybe, yes. But you need to understand how these things actually work and all the other levers that can be pulled and all the things that can change that can have a massive impact on your policy. It's really, really important to understand that, guys. So, all right, let's go ahead and pull this up and let's break it down.
Yeah,
So
can you see that there?
Yeah. Yeah, we can see it. Go ahead.
Okay, perfect. And by the way,
Go for
I
it.
didn't answer the question fully. I wouldn't recommend it as a retirement vehicle or investment vehicle. I wouldn't necessarily recommend it as an insurance vehicle, especially when you consider all the risk, right? And why would you want risk in your insurance policy? The only place I would potentially recommend it, by the way, and not that I would recommend it, but you could safely say my client won't lose money, is if you have a return of premium rider. So there are a couple policies, very low cost, and then they have a return of premium years like 21 through 25. I can tell you Mutual of Omaha is one of these companies. There are some companies that have it with the GUL as well. But this is a product where if a client wants to take on a little extra risk because they want to get a higher death benefit and maybe they don't have the budget to go a little higher with the whole life,
Right.
They could try that. And then knowing that, hey, as long as I'm not borrowing from it, I'm not injecting that extra risk in 20, 25 years. I can take my money back if I'm not happy with the performance. Right. But you may have lost some opportunity costs. Right. So
sure. Makes sense. And just the final point on that is what I want to end with on this video is the alternative to IUL that you and I were discussing before. I don't think a lot of people know that it's available, but if you are sold on the concept of upside potential and downside protection with an IUL, potential tax-free retirement income, whatever, you can get that with a whole life product, guys. I just want everybody to know that. Every IUL video, I want to make it a point to let you guys know that you can get upside potential, downside protection in the market without all the potential issues of IUL. All right, so maybe we'll finish up with that, but let's go ahead and get into the illustration. I'm really curious to see what she put together for you here.
Yeah, Matt. Not to mention, you can get it without affecting the guaranteed side of the policy. Your guarantees.
Correct.
But so this agent, she was with the Premier PFA, Premier Financial Alliance. They have a proprietary product from National Life Group called the Living Life Defender. So not all the companies have this product. There's a couple extra things that they include, but let's get into it. I crossed out her name. I actually like this agent. I'll say this, I don't think she was intentionally trying to harm me.
Sure.
She just doesn't know what she doesn't know. Right. So she said some things that were not accurate, and I'll point those out where those are. But I think
that's, would you agree that that's probably most of the time the case with most agents? I don't think anybody really wants to hurt anybody. It's just, you don't really know what you don't know. Right. And
right.
Unfortunately that can lead to bad, financial decisions and consequences.
Yeah. I want to believe most agents are like that are, pushing this product the way they are. I do believe there are a few agents that they know exactly what they're doing, but it's such an easy sell, so easy to take advantage of people,
right?
That they do it anyway. So, but I went through this. I already highlighted some key areas. So number one, may lose value, right? And that's something that's not talked about with IUL, right? Downside protection, upside potential. Basically, it's sold as something that you're not going to lose money in, right? But
I heard, and I was watching a YouTube video the other day from an IUL agent. She said you cannot lose money in this thing.
Yeah,
it's a half truth because they're talking about the stock market. Well, that's true, but you can still lose money in an IUL.
Right. Any year
you need to know that
any year that the interest does not cover the cost, including loan costs, you are losing money in IUL. You can lose 30, 40, 50% in any given year in your IUL. So obviously the more loans you have out, the more risk you inject, the more cost there is. And so that's when people get into trouble, right?
Yeah. Those percentages would be more like later on down the road. You've got $1 million, $1.5 million in loans or whatever you're doing, indexing, participating loans and stuff like that. You're 80 years old. That's when that's when it could go really bad.
Yeah, and that's the true problem with IUL is you're not going to see any problems until it's too late.
Yeah,
Right,
that's
so,
really unfortunate. So okay, so you're at 500 a month here.
So I told her I could do 500 a month. Yeah. So what she did was she gave me a $400,000 base, and then I highlighted that she went with a 30-year combo. So obviously 30 years is costs more than 20 years. I'm 40, so this would take me all the way up to age 70. You know,
so okay, so you're paying you're paying premiums until for 30 years until 70 in this one.
I'm paying to 65, but the cost for this extra rider is in there till 70. So
okay,
I would have made it a 20-year, extra term rider. I probably would have actually evened this out, maybe 300 or even lower on the base, but it definitely wasn't the most efficient policy, but that's okay. They have the projections here, right? So your terminal illness benefit.
Okay, the living benefits. Okay.
Yeah, so that's what National Life Group promotes the most, right? They're the original living benefit provider. They're the king of living benefits.
Okay.
So they have all four, right? So the terminal, chronic, critical illness, and critical injury. So it does show you. Now, I highlighted this in particular for the agent that I'm going to be going over this with. This is at age 66. But remember, I have extra coverage, right? So these might change.
Okay. In fact, real quick before you scroll past that, I want to talk about a couple things with the. Can you scroll up just a little bit?
Sure.
To the. I want to talk also about this lifetime income benefit rider. Okay, because I have heard this a lot from like especially when I was starting to go down this rabbit hole, infinite banking, cash value life insurance, and all that. And living benefits was a term that was thrown around all the time. Like I heard it constantly. Like it's a big sell with these things. And living benefits can be great. The problem is, are you going to have access to those living benefits? Again, if we are buying a particular product for a specific reason, and then we don't have that available to us when we need it, what are we doing? Okay. So is it guaranteed that you're going to have the living benefits available to you if you don't have any cash value left, if the policy lapses, or if you turn on the lifetime income benefit rider? Okay, if you read the fine print on these things, like the lifetime income benefit rider, when you turn these things on, your living benefits go away. You need to know that. Is that a deal breaker? It would be for me, maybe not for somebody else, but you should know it. I don't know if you're watching this and you knew that, but when you read the fine print of these things, you actually lose. Like it's showing lifetime income benefit rider here is that okay? So that's a monthly income of $1,400 a month. If you turn that on, Michael, correct me if I'm wrong. Maybe this product is different. Would you lose the living benefits at that point if you turn that income rider on?
Yep. The company reserves the right to take off all the riders if you turn the income rider on. And
when
it's
you say
in the
reserve the right, so maybe they will, maybe they won't. So you don't know, or like, is it? Do we know if we're going to lose that or not?
Well,
or is it just
I would say
up
this.
In the air?
I would say this: anytime they include that in there, there's a reason why.
Right.
You know, they don't just include that in there for no reason, right?
All right. So, well, I wanted to clarify that because I saw that lifetime income benefit rider. I was doing research on that the other day, and it sounds like it's a really good thing. Again, when you read the fine print, guys, you might not even be able to turn that rider on. When you read the fine print on this, and actually, I think the one that I saw, it was from is it NLG, right? Yeah. And it specifically says you need to have a sufficient amount of cash value. You can't have any policy loans. There's other restrictions in place where you might not even be able to turn that rider on. Please just be aware of that, guys. Sorry, Michael, go ahead.
Yeah. And actually, most like high level IUL agents that truly believe in IUL, they would actually argue that you don't want to turn the rider on. You want to take policy loans.
You would just take policy loans, right?
Right. Because once you turn the rider on too, you don't take advantage of the market gains.
Right. And that's why I didn't understand the point of the lifetime income benefit rider. I had somebody on my channel like really going hardcore about the lifetime income benefit rider. But then when I read it, I was like, what is the point of this? I don't understand. Why not just take policy loans? That way you could still potentially have your living benefits. Like it doesn't cause any potential other issues in the policy. It seems like a pretty useless rider. And
honestly,
from what I've seen thus far, I would love clarification on that, but I can't understand why anybody would use it.
Well, I think it's as simple as this. I think people are starting to wake up to the fact that they can lapse their policy through policy loans. And so it's really just there as a selling point.
Right.
Just
so
like the
get
other
this income for life. Don't lapse your policy from policy loans. Do the lifetime income benefit rider instead.
Right. And it's like, dude, you might as well save your money somewhere else and then put it into an annuity if you want to do that, right? Be more efficient. But yeah, it's in here too. We'll definitely hit that. Obviously in the fine print, this is pretty much on every page, by the way. Benefits and values shown are not guaranteed. Assumptions on which they are based are subject to change by the insurer. Actual results may be more or less favorable. This presentation is not valid unless accompanied by a complete insurance company illustration. Please see the ledger. Yep. Please see the ledger of guaranteed values and other important information. So
guaranteed values are pretty useless, especially if it's target funded.
Yeah. So I think this is important too, because you do have agents out there that they don't show the illustration, or they might show 2 pages, or they have their own software where they make up their own numbers, and you got to be aware of that for sure.
And real quick, is again, I'm picturing the comments we're going to get. Dividends are not guaranteed either. Okay, the illustration you see of a whole life illustration, whatever, the numbers you see there, not guaranteed. You know what? You're right. Dividends are not guaranteed. We don't know where they're going to go. At the time of this recording, they're pretty much at rock bottom. So if you're setting up your policy now, you're probably going to be pretty good. Not to mention that the companies, at least Michael, the ones that we work with, have always paid a dividend for over 100 years, almost 150 years every single year, like throughout all the chaos. So not really an argument, but I do want to address that because I can already see it in the comment section.
Yeah. Well, 2 things, right? Number one, you look at the history and you're just like, man, these guys pay dividends during the Great Depression, during the Great Recession, every up and down of the market. These guys,
every stock market crash.
Right. They've been able to pay the dividend to the policy owners, which, by the way, are owners of these mutual companies.
Right.
You're basically a stockholder with these companies. The second thing is in a whole life, you do have a guaranteed portion that is guaranteed, right? Like my policy gets 3.25% every year, no matter what, guaranteed. The dividend portion is on top of that, right? So you might get half of, or a portion of what you're expecting, but there's no risk involved, right? If you pay your premiums on time, your whole life insurance is guaranteed.
Right.
Whereas on this policy, you can pay your premiums, but if it doesn't perform, you're losing everything.
Right.
So there's a big difference there.
Right.
Let's be clear on that, right?
Yep.
So I highlighted this, and this is just because people don't realize this, but the tax deferred buildup of the cash value provides me with values that I can borrow or withdraw. Income tax free. You see the little number 2 there.
Yep.
And it says withdrawals up to the basis paid, which is basically return of premium.
Right.
And then contract, and then loans thereafter will not create an immediate taxable event. But substantial tax ramifications could result upon contract lapse or surrender. So I think a lot of times it gets sold as tax-free. There's no risk, and it couldn't be further from the truth.
Right.
You have to know this. That's why it's so important to not lapse the policy, right? To have these riders available. Mm-hmm. But you also have to meet the qualifications for them too, right? So
sure. And again, I want to be fully as transparent as I possibly can here with this video. The same thing can happen with a whole life policy. It's just not nearly as likely to lapse. Like Michael, correct me if I'm wrong, but really the only way to lapse a whole life policy is if you are extremely irresponsible. You leverage the crap out of it, taking policy loans, and you don't pay those policy loans back and they get away from you. It's really the only time that a whole life policy can lapse. Otherwise, it just grows every single year. So can it happen? Yes. You would still have the same tax ramifications. It's much less likely to happen unless you're very irresponsible with the policy. That's all.
Yeah. And that's one of the reasons I said your life insurance policy should not be your retirement vehicle, period.
Right.
Right.
It can supplement it. It should not be your main source of retirement income, guys.
Right.
Volatility buffer, little extra tax retirement income, maybe. Shouldn't be the main thing.
Yeah. Yeah. But I did want to point that out because, you know, like I said, people don't realize there are ramifications on taxes.
Yep. And there's the fine print really quick, right below the one you read. I think you highlighted it too. Scroll up just a little bit. That's the lifetime income benefit rider right there. Qualifications must be met. An additional premium must be paid. That's a little bit different than what I read, but make sure you read those, guys. Very important.
Yeah, there's actually a fee and premium for all these riders. So
yeah,
it'll talk about that in here. Obviously, here's what's being sold to me. Age 70. You know, they're projecting 220,000 in cash value, net death benefit to 268. Right. So remember, these are
at age 70.
At age 70. So these are projections, right? Based off of, and we'll go over the index that she put me in. It's actually it's going to show on this, you know, really great returns. Mm-hmm. But we'll actually look up the history, and you'll see that that's not.
It shows the percentage rate too that it's illustrated.
Yeah.
Right.
Yeah.
Okay.
So here's the riders. We got the accelerated benefit rider. You know, lets me access a portion of my death benefit while living. Mm-hmm. So terminal, chronic, critical illness, and critical injury. This one I thought was interesting. There's another rider, accumulated value enhancement rider, to grow my cash value accumulation potential, right? Not to grow it, but to grow its potential. Provides an interest boost annually beginning in policy year 6. Additionally, a client appreciation
every 10th policy year.
Appreciation bonus may be provided every 10th policy year. Again, there's a little number 2 there. So if we go down to number 2, we find out that you're paying for this rider potentially. The client appreciation bonus is not guaranteed and will be credited or not credited at the company's sole discretion.
Right.
So that's important.
Okay. Yeah. And that, right. It says there's an additional charge for that rider.
Right. You got your combo. Yeah. So this is the term, the extra 30 years of term that she gave me. We have a guaranteed flex rider to protect my death benefit. When the guaranteed premium is met, the guaranteed flex rider provides a secondary guarantee that the policy will not lapse, thus protecting my death benefit. The guaranteed flex rider, a guaranteed period election for this illustration is 10 years. So this is what I was saying. You know, a lot of these policies give a 10, 15 year rider from the first 15 years, let's say. Mm-hmm. I was actually going over another guy's North American IUL, and he was paying for this 15-year rider. I said, well, you're funding this policy pretty well. This policy isn't going to lapse. Like if you look at the guaranteed section, it has zero chance at lapsing. So if you're funding it, why are you paying the extra few dollars? I think in his policy, it showed a extra $7 a month. Mm-hmm. Why wouldn't you just put the extra $7 in your cash value?
Right.
Like it's not.
I mean, not a crazy amount of money, but it's still just like it. You know, those things add up. You know, it's not the only cost. It's not the only fee that's eating away at the cash value.
Right.
You know, that stuff can add up over time.
And that's what we're going to go over in this policy. You're going to start to see all the fees start to add up, right?
Right. So, and is that rider? So like when it says that it protect a guaranteed period elected for this illustration is 10 years. Is that like a rider that you turn on and then the 10 years starts kicking in, or is it just because it doesn't really specify, or is it the first 10 years of the policy, or like, is it a rider that you turn on?
So all these protections are for the first 10, first 15. Yeah. I've even seen first 20 years.
Yeah.
But typically that's not when the problems.
Right. It's useless, man. Right. Because these policies don't typically start having issues until people are older and they start taking income. They start taking policy loans.
Right. Right. And then just like you said right here, lifetime income benefit rider, I had to highlight this, when sufficiently funded,
Which is
right?
yours is not.
So it may qualify because it is above target. So I'd have to get more information on that. But yeah, that's important to know, right? So here is the important information regarding the lifetime income benefit rider. So there's some qualifications. You got to be between 60 and 85. The policy has to be in force at least 10 years, which it would be.
Right.
But let's read the highlighted sections. Receipt of income benefits under this rider will reduce the policy's cash value and death benefit and may reduce or eliminate other policy and rider benefits.
That's huge, guys.
Talking about your living benefits, right? So
yep.
If you turn this rider on, for example, it's going to show $8,000 of income, nothing to get excited about. But imagine turning the rider on, $10,000, let's call it, and now you get cancer and you don't have your critical illness rider anymore.
Right.
So you can't access
and you were planning on it.
Right. Now
you will have not know that.
You will have some cash value, but yeah, you won't have the full benefit, right? So,
right.
And you can't take policy loans when the rider's on, by the way. That's the other part too.
Interesting.
So if you do turn, and watch, I'll read it right here. Through the automatic ratchet feature, your lifetime income may increase every 5th year, every 5th lifetime income benefit anniversary, if your net cash surrender value on the anniversary is greater than the previous 5th lifetime income benefit. And then we have the benefit payments. The benefit payments are funded via policy loans, which will reduce, the policy's cash value and death benefit. The policyholder cannot make additional premium payments or request withdrawals or policy loans during the income payment period.
That's what doesn't make sense to me, dude. Like, why not just take the policy loans yourself and not put your living benefits at risk? Plus, there's a charge for this too. There's not a charge to take a policy loan other than the interest you pay. But why do this when you could just take? Because it's literally saying right here that this is being done via policy loans.
Right.
Why not just do it yourself where you're in control and you don't lose your living benefits? I don't understand. Yeah,
there's a guy out there. You know the guy. He was on Chris's channel, just trying to fight for IUL. Anyways, he thought he came up with something revolutionary. He's like, "Oh man, we got guarantees now." He showed me this, and I was like, "Oh boy."
Oh, the guarantee was the lifetime income benefit rider?
Yep. Yeah. And now, when you're actually learning about it, it's like, probably don't want to go that direction.
Yeah. Look, guys, the point of this is there's always pros and cons to all of this stuff. It's always give and take. They're not just giving you this amazing lifetime income benefit rider. There's always a price you're going to have to pay for stuff like this. Just read the fine print, guys, please. Just know what you're doing, know what you're getting your money into, know how these things work.
Yep. Let's see here. So we have the increasing adjustment is equal to the benefit payment for the prior year multiplied by the annual increase percentage, currently equal to 3%. The rate is subject to change prior to exercising the rider. So even that, they're telling you, hey, we can still change this if we want. There's no guarantees that you have here, other than the policy won't lapse if you do get to exercise this, right? So,
right. But I mean, the next one is saying policy loans and withdrawals reduce the policy's cash value and death benefit may result in a taxable event. So because the fact that this rider is basically automatically taking policy loans for you, there's an interest cost to that. Mm-hmm. Is there not? I don't know if it's a participating loan or what do they call it, a wash loan or whatever it is.
Yeah.
But either way, you either have money that's not participating in the market anymore, or you're racking up this, you're compounding this interest against you. So
right.
How long is it actually going to last? I don't know.
Well, with the rider, it's going to last your lifetime, which is the benefit, but you're taking so much less income and you're losing all the other benefits that, to me, it's just not even worth it.
Yeah.
Right. This is another thing right here. The current charge for this rider is 65 basis points applied against the policy cash value each year once the NL Group lifetime income benefit rider is elected. You have to elect it at the beginning. You have to say, I want it on the policy. The maximum guaranteed charge is 150 basis points or 1.5%. So we're talking about all these little fees adding up, right?
Yep.
And there's another one right there.
So the current charge for this rider is 65 basis points. So you're paying for that the entire life of the policy, not just when you turn it on.
Yeah, once it's elected. So that actually may come when you turn it on. So I'll tell you,
that would make more sense.
That would make more sense. But
yeah,
I will say this: the agent who sold me this definitely gave me some things that were not factual. Like I said, I just don't think she knows any better.
Mm-hmm.
She said the living benefits are free. Now, it's true that there are no extra premium charges, but once you have to use the benefit, they do charge you at that time, right? So it's not free. She said you could pay off this IUL in 15 years. As you know, you cannot pay up an IUL.
Right. You can't do that. You could stop making premium payments, but it's not paid up.
Right. And it's in here too. And then she also said this is what it would do conservatively. and that drives me nuts knowing what I know. So
it's like probably the most dangerous word when it comes to IUL, conservatively.
Yeah. It's hard when you're looking at this kind of charge, right? And all the little charges that you get. So this is a big thing right here. So a lot of agents, they kind of shy away from the S&P because of the caps. I did this on my video. The S&P is your best option, period. If you're, and I say this because I do, even though I don't sell IUL, I do sell fixed index annuities, right? And so the fixed index annuities are the same thing. The S&P always has a cap, and then they always have these other options that are not capped. So in this case, it's the US Paysetter and the Credit Suisse. These are what's known as volatility target indices, right? So the whole idea here is it seeks to provide a smoother ride than the highs and lows of the general market. So let's just pause here and break this down. I think this is very important. The reason that the insurance companies have these proprietary indexes that they've engineered is because it allows them to control the cost of the options, right? Because what you're doing is you're in an option strategy. You're buying the option. If the market goes up, you exercise that option, you capture the gain. And if the market goes down, the option's worthless, but you only put a portion of your money in the option. The other portion was all in fixed investments, right? It's all, the option budget came from the fixed performance of the general fund, right? So low volatility, what they do is if any stock is volatile more than 5%, they'll actually take it out. And when you understand options and what drives the price up, it is volatility. So you need the volatility in the market to capture gains.
Right.
Right. So it's like counterintuitive, right? It's like a catch-22 here. Like you're trying to control the cost, but you're also reducing the performance.
Right.
And so these strategies as a whole, and I could show you a sheet, but I'd have to find it, but they perform between 2 and 4%. And then a lot of them perform negatively. And this agent put me in the US Paysetter. So let's see what the US Paysetter shows. It's going to show a 5-year average, 13%, a 10-year average of 12%. Look at the 20-year average, Matt.
And this is all based on a look back period, correct? Like, because guys, a lot of these volatility indices, they have not existed for very long. So there's no real proven track record of these things whatsoever. So that this is all based on a look back period.
Yeah. And let's do this. I'm gonna actually just go and search US Paysetter. Because I want clients to see, because clients don't know. They just see those numbers on the sheet.
Right.
And it's like,
It's like,
oh, great.
15%. That's great.
15% does sound great, right?
Yeah. And how long has this one existed, Michael?
This one's existed about 2 years. So none of that performance is even real.
Okay.
So
we're rolling our dice on an index that's only existed for 2 years.
So
be my guest, guys.
Here's the case. I have a sheet about 5 or 6 pages of these indexes. All the indexes that show more than 6%, they've been in existence less than 5 years. And then all the ones that have been in existence more than 5 years, they're typically 2 to 4%.
Wow.
Just to give you an idea how the volatility indexes work. That's why I tell you got to go with the S&P. I know there's a cap, but it's the better option. You're going to get better growth unless you're lucky. You could get lucky. Don't get me wrong. You hit at the right time.
Sure.
Some people got in right when there was that dip after COVID and everyone got locked down, and then everything shot back up.
Right.
So you did have some crazy returns, but I mean, honestly, when you look at the averages, it's like you're trying to play the lotto.
Mm-hmm.
And it's like you have all this risk in the policy and you're shooting for the lotto. So, right here, you look at the inception date. We're talking about December 2021. So a little bit over 2 years now. Mm-hmm. And if we look at the red line, it started here. And this index has performed negative since its existence.
What is the plus 226%? What is that?
Let's see.
So it's got, so like right there, it's got.
Yeah. I think it's from the beginning. So if we go back. Yeah, because it's 0 from the beginning, right? So based on March 2002. That's how much they're saying it would have grown.
Oh, okay. If it had existed.
If it existed, right?
Okay.
So right here, they're comparing it to the S&P. The other line is the S&P index.
Okay. But what you're showing here is that from its actual inception date, it's performed worse than than if you were to be invested in the S&P 500 itself.
Correct. But even more importantly, it's performed in the negative. And yet somehow the insurance company is able to tell you, hey, this thing can perform at 15% over the last 20 years.
That's crazy, man.
Which is not even true.
That's crazy.
So that's the other part. You got to understand it's all smoke and mirrors.
Here's the thing, guys, is you know what? Don't take our word for this. Okay. What I want you guys to do, if you are considering an IUL, I'm going to put a link to that website. I want you to pull that website up next time somebody is pitching you an IUL, US Pace Setter Index, whatever. Show them that chart and have them explain it to you.
Yeah.
And if they can't explain it to you, is this something we really want to do? Maybe. Probably not.
Yeah.
Ask your agents about this, guys. Because it is so good to see this stuff on an illustration. IUL looks phenomenal on an illustration. What happens in real life? So when you bring that chart up to an agent, I would love an IUL agent selling this product to explain that to me. That chart that you just showed us. I would love to hear what they say.
Yeah, and if you want, I do have a video. It's on IUL on my channel, IC Life. Go in there. I actually show the whole sheet where you can see all these indexes underperforming.
That'd be awesome. I'll have you email me that link and we'll put it in the description of mine too.
Yeah, definitely.
I'd love to watch that.
But the reason I bring that up is because even though I don't sell these, I do love fixed index annuities, but you got to kind of avoid the hype because they're going to show you these illustrations that are 15%. There's not the same regulations on that side.
Right.
So instead of showing you 6%, 6.42 like this one will, it's actually going to show you the 15.88.
Right.
So it's insane.
Man, that's crazy.
But yeah, it's not real, right? It's like, okay, the ones that actually perform that have a history are the ones everybody knows, the S&P, the NASDAQ, and the Dow. Mm-hmm. And there's not very many options that companies that offer the Dow. There are a few that offer the NASDAQ, which is actually my preference, but the S&P is pretty much the standard with all carriers, right? So
it's a safe play.
Yeah. So I wanted to point that out because it's like, man, they're going to show me all this return, and that 8,000 is based on this hypothetical great return, and it's not even real.
The 8,000 per year with the benefit, right? The lifetime income benefit rider. Yeah.
Right. Just mark this. These values assume current charges and interest. Benefits and values are not guaranteed. The assumption on which they are based on are subject to change by the insurer, and actual results may be more or less profitable than those shown. So it's just talking about these projected numbers, right? Cash value at 65, cash value at 100.
But then also it says in the fine print, if you scroll down a little bit, based on policy guarantees, the cash values are 51,000, blah, 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 at age 65 and 0 at age 100.
Yeah. So
basically saying, correct me if I'm wrong, policy is guaranteed to lapse at 100.
Yeah.
Right?
It's
which is not bad for an IUL. I've seen IUL policies lapse at like 60.
Yeah.
Before 65 in the guaranteed section.
I'll say this.
My point of bringing that up is like you'll never see that in a whole life policy, guys.
Yeah, and I'll say this: I don't believe the guarantees will happen, like the worst case scenario.
Sure.
Because it does require you to basically not get any interest credits ever.
Sure.
Right.
It's just I've heard IUL agents make that argument though, like, oh well, IULs have guarantees as well.
They
really?
Don't. Like
really? That's not what you're selling it on.
Yeah. I mean,
if you did, you wouldn't sell IUL. You wouldn't be able to sell it. It wouldn't make any sense.
Well, I think the guarantees won't happen. Not getting any interest credits.
Correct. I agree.
It does point out that you really don't have very many guarantees at all, right?
Right.
So that's really what it does.
Good stuff.
I kind of look at it like there's 3 columns, right? There's the high end column where they show the 6.42, and all these agents are saying conservatively, but probably you're lucky if you get there. But same thing on the guaranteed, right? You're probably going to get some interest credits. In fact, I would bet that you will get plenty of interest credits. So I think you're going to be somewhere in the middle,
sure.
Right? And you got to kind of look at that middle column, that 3.5, 4%, right?
Yeah. But then it's like at that point, why not just do whole life? Because with whole life, you typically net 3 to 5% tax free anyways. Like,
yeah.
Why roll the dice when you can get very similar? And again, like I mentioned earlier, you can get upside potential and downside protection in the market in a whole life product as well. Like,
right.
What's the point? So anyways, continue. Go ahead.
So Matt, check this out. This is, I told you, she told me there was no cost to these benefits, right?
Mm-hmm.
So I have a $400,000 face plus the $200,000 in term. You can accelerate up to 100% of the death benefit.
Okay.
Yet, if I get a terminal illness, I can get 346.
Interesting. Why is that?
That's because the cost comes out at that time. So
that's a big cost, man. That's $54,000.
Right. Like I said, it's all on how you word it. It's no additional premium as far as coming out of your bank account.
Sure.
But is it free? No, it's not free. Right. So that's an important differentiation, because she did tell me it was free. And so
you gotta be careful with that.
Yeah.
And that's probably an honest mistake by her. She's probably not intentionally trying to mislead you or anything, but that stuff is important. You got to know what you're selling, guys.
Yeah. And like I said, I actually liked her, during the conversation. I'll say this too. She didn't try to sell it as a retirement vehicle. She did do a good job sticking to the coverage and the living benefits and things like that. So
that's good.
Like I said, overall, I think she just didn't know, or, it's just these little things that most agents don't know. Right. So, value shown in your illustration assumed some changes are made. to the policy at certain points in time. Following changes are illustrated. They will not be automatically processed. If you want the changes in the illustration to take effect, you will need to take action. So I think also a lot of agents don't realize like they need to be managing these policies.
Yep.
Because just because you set things to change at certain times, it's right here that they don't automatically change. You still have to go change it, right?
You have to make those changes yourself, guys.
Right. So
if you're going to turn a rider on, whatever it is, or you're going to change it from increasing to level, death benefit, whatever, you just make sure that you do that. You have a set date where you're going to do that, because it doesn't happen automatically.
Yeah. So let's see. Got the plan description. Illustration assumes that the currently illustrated non-guaranteed elements will continue unchanged for all years shown. This is not likely to occur, and actual results may be more or less favorable than those shown. Interesting.
There you go. Just important to know.
So the guaranteed will lapse at year 33, as you can see down here.
Unless a higher premium is paid.
Mm-hmm.
Yep.
So here it is.
And that's that is partly or a big part of like how it's designed as well. If it's designed properly, then that won't be as big of an issue.
Right. So here's the big part right here. This is going to talk about all the variables that are in the policy. So keep in mind with non-guaranteed illustrated values that they illustrate interest rates and policy charges that are assumed to continue unchanged for all years shown, and that they are not guaranteed. This is not likely to occur, and actual results may be more or less favorable than those shown. Non-guaranteed benefits and values are not guaranteed. The assumptions on which they are based are subject to change by the insurer. The rates for the percent of premium expense charge, monthly cost of insurance, monthly expense charge, monthly policy fee, monthly percent of accumulated value charge, rider charge, withdrawal fee, and accumulated value enhancement, if any, are not guaranteed, will be determined by the company and may change from time to time based on expectation of future anticipated or emerging experience. These changes may include, but are not limited to, the increase, reduction, or elimination of the listed rates and amounts after a certain number of policy years. Future anticipated or emerging experience can include, but is not limited to, investment earnings, mortality, persistency, taxes, and expenses, which may affect these assumptions. Actual results may be more or less favorable.
Good stuff.
That's a whole list. That's a whole list of stuff that they have the controls to the levers, and they could just change it on you.
Yeah. And again, guys, it's not necessarily to say that you shouldn't do IUL. You just gotta know these things, man. You gotta know what you're putting your money into. So,
right. Basically, what this does is, if the insurance company gets in trouble, they're not taking any risk with this policy. You are truly bearing all the risk here.
Yeah.
So, when you're thinking about it as an insurance policy, the whole idea of insurance is transferring that risk,
right? But
you're actually failing to do so.
And my question always is the, if we're comparing like if you're on the fence between like whole life and IUL, is the extra couple of percentage points in potential growth worth all of these levers, all these things I could change, all the risks, all the things that could go wrong? Is it worth those extra couple of percentage points? To me, the answer was pretty simple. It's not. I'd rather know exactly what my money's going to do, and I don't have to worry about cap rates, participation rates, all these charges, all of the what the stock market's going to do. I don't want to mess with that. It's just it doesn't fit my risk appetite.
Yeah, I'd argue, Matt, that it might be 50 basis points potentially you're getting extra, right?
Yeah.
Maybe 1% on the high end. I wouldn't even say 2%, but if it's 50 basis points, is it worth all the additional risk?
No, not at all.
So let's see. I highlighted this. The interest bonus will never be less than the guaranteed guaranteed interest bonus percentage. So it's illustrated with the bonus of 0.25% here on the US pay setter right there.
Okay.
30 basis points and then 35 basis points after year 31. But the guarantees are 15 basis points throughout all years. So
Okay.
they can always drop that down. Participating loans. So this is where you borrow the money, right? And then you're hoping to still capture the interest credits from the index strategy.
It'd be the equivalent of non-direct recognition,
Right.
life insurance company, whatever. Non-direct recognition, or did I say that right? Non-direct recognition.
Right. Non-direct recognition. Yep.
Yeah.
Policy interest rate is 5.9%. This
You better earn more than that every year.
So basically what they're saying is if you're borrowing, I mean, 5.9% plus cost of insurance, you're talking about over 6%. So if you're borrowing from the policy, if you're not earning 6.5%, you're losing every year because of the charges. And, people talk about compound interest working for you. They don't talk about the compound interest working against you in this case, right? So when you start borrowing these policy loans, even at just 5%, Matt, can you guess what 5% compounded over 30 years comes out to?
It's a lot. I've played a lot. I've messed around with compound interest calculators quite a bit. It could be a massive number.
Yeah,
over a long period of time.
I think it's about, I want to say it's 352%. So, I think people get so caught up in, yeah, but you don't pay taxes. Yeah, but you pay 352% interest on that first year, right? If you live to 90, you start at 60 and you live to 90. So,
and here's the thing. Here's something I want to address with this, Michael, is so with let's paint the picture of doing a tax-free retirement income with a whole life policy. All right, you're going to pay interest on that loan just like you would an IUL here. Okay, here's the biggest difference, guys. Is with an IUL, this is where like you really start to inject a lot of risk into the policy later on when you're older. Your cost of insurance has gone up. Okay, maybe the net amount at risk isn't significant yet. It can absolutely get there though. So you've got cost of insurance that is skyrocketing. But what happens when what is shown on an IUL illustration showing credit every single year, and you've racked up a policy loan taking income? Let's say your policy loan's at $500,000, $1 million. Heck, if we follow the illustration the IUL agent sent me at $212,000 per year, it wouldn't take me long to get to $1 million loan balance. Okay, and if I'm paying 5 to 6% on that loan, and I don't get that interest credit that year because I have a 0 year, I have cost of insurance, whatever fees are also still being taken out of the policy. Now I have a massive interest charge. If I've got $1 million loan and I pay 5% interest, Mike, is my math right? Is that $50,000?
Well, in this case, it'd be 59,000.
Right. And where does that come from?
That comes from your cash value. Yeah.
It's taken out of the cash value, which what does that do at that point, Michael? Correct me if I'm wrong. That then increases your net amount at risk.
So you won't
actually value's gone down.
Yeah, your available cash value is what's called surrender value, right? So it won't show in your cash value, but it will show in your surrender value. You could take a 50% loss right there easily.
Yeah.
And so 2 bad years can actually knock this policy out completely.
Right. Versus, go ahead.
Yeah. So it can knock the policy out, but yeah, it's basically, you have to get this credited. It's why as an IUL agent, before I just completely realized like I just can't sell this at all anymore, I actually started leaning towards other companies like North American because they had a bonus in there that guaranteed 2.65%. So even if I had a down year, it would slow things down a little bit, as far as I would get some interest credits still,
right,
to kind of offset that loss. But then you deal with underperformance in that case, because it does, obviously it affects your budget that's going
Sure.
towards the options. So you're getting less performance. But,
Sure.
for me, I was like, I like the guarantee. So I think that was already a sign I was starting to lean towards whole life, because I was looking
Right.
for guarantees to protect my clients.
And again, the issue is not always the policy lapsing. It is now, like, if you take that big of a hit in your cash value, that's less income that you can take for a longer period of time. Like, and if you were planning on taking income from this thing till you were 100 years old and you're 75, and now you're 80 and your cash value is getting crushed by cost of insurance, interest expenses, because you have, guys, you're going to have multiple 0 years in your retirement. The stock market does not go up every single year like an IUL illustration would have you believe. It does not happen. And when you rack that up, that's it could put a lot of strain on the policy, and the most likely scenario is you're not going to be able to take the amount of income that was illustrated to you for as long as it was.
Right.
Like that's the likely scenario, even if the policy doesn't lapse. Like, it's just stuff that you have to be aware of. Versus the final point I was going to make, Michael, I'd like your feedback on this too, is versus a whole life policy where you do have those interest costs. The difference is we don't have rising costs of insurance. Okay. We know exactly what our fees are. Like they're level throughout a whole life policy, number one. And number two, the whole life policy is guaranteed to grow every single year. Not to mention that with the dividends, are they guaranteed? No, but they've paid them for almost 150 years, sometimes more than that. So will the policy, as long as you don't over leverage it in a whole life policy, you're much less likely to run into any issues.
Right.
What are your thoughts on that?
Yeah.
Am I crazy? Did I miss anything?
No, you're not. The dividends are not guaranteed, but like you said, I call them one of the safest bets that you can possibly make for something that's not guaranteed.
Right.
I mean, they've paid out dividends in the Great Depression, in the recession, like every season that we've been through, the economy's been through, it's continued to pay dividends, right? So I think that's a pretty safe bet. Is it guaranteed? No, but in a whole life, you are sitting on the same side of the table as the insurance company. Whereas in this policy, they're going to profit if you lose, right? You don't have any ownership of the company in a policy like this. So it's a big difference, right? You want to align, you want the people that you're giving control to be aligned with you and be in a situation where you win, they win, right? Like if you were to go to a investment advisor, they're going to charge you a fee, right? So they're incentivized to grow your money and make sure you win, because that fee gives them more money if you have more money, right? So they're on the same page on this. In a policy like this, you're actually on the opposite side of the table. It's kind of like a term policy, right? It is a term policy. What you don't see here is it's built on annual renewable term, right? It's not, it's qualified as a permanent policy, but it's not guaranteed to be permanent, right? So
I hate calling IUL a permanent policy because it can absolutely fail and lapse. And I just want to point out too, like one of the parts you have highlighted there, when indexed interest credits exceed the policy loan interest rate charged, your policy will earn more on collateral amounts than they are charged on the loan amount. Makes sense. Okay. But then it also says the opposite condition can occur where the indexed interest credits are less than the policy loan interest rate charge, which means the loan balance is growing faster than the indexed interest credits. Guys, just be aware of this. Not saying not to do IUL. Okay. Maybe it's right for you. Maybe you like rolling the dice. I get it. Dice are fun to roll. Okay. But just know what you're getting into. Okay. Understand how these things work.
Right. And it becomes a slippery slope, because once you get your first zero and you all of a sudden introduce all this extra risk and all these extra charges, right? That second zero compounds on it. So it's kind of a slippery slope there, but that's why they sell like this lifetime income rider, right? So this is how she set me up. You can see the guideline premium is $14,318. and the target is 5930. So I'm paying 6,000. So she basically set me up almost at target, a little bit over.
Can you explain really quick why that's a problem? So this is not a max funded IUL, correct?
Correct.
This is funded at target premium.
And like I said earlier, she told me it was properly structured,
Right.
which most IUL agents that actually are high level IUL agents, which is really not that many out there. There's a few, like Brian, for example.
Yeah, Brian was good. I
Yeah,
that was a good conversation. He seems to he really knows his stuff
yeah,
when it comes to
and
IUL.
people like that, I know they're going to manage the policies with the client. They're going to help the client. And the other thing too, this is something people don't talk about, but assuming they're around,
Sure.
right?
And they're
Like
still in the business.
Brian might help the client through their whole retirement and successfully land the plane, so to speak. But what if he's not around?
Sure.
Right. And the person doesn't know how to do it. Now, I know he does take people through an extensive process, educating them so that way they can hopefully navigate their way. But, a lot of people, a lot of clients, even though you tell them by the time they get there, they're going to forget, right? It's not what they
Right.
do. So,
Sure.
but the reason you want to fund it, so she did set me up at level. And what level does is it, so I start with 400,000 of the base policy.
Mhm.
And then as I make those premiums and I build the cash value, it reduces the cost
Right.
because that cash value replaces the coverage or the net
Sure.
amount at risk. So if I have 100,000 in cash value and I have a $400,000 base benefit, I only have to pay for insurance on 300,000.
Right.
Right. So this is where the whole idea of structuring, comes into play. It's not really structured differently. It's just to me, like I said, I hate that term. It's really a bad term. I think funded properly would be a better term. Managing the net risk, right, would be a good term.
That's the key is managing that net amount at risk. That's
Right.
one of the most important things you can do with these policies.
Yeah. But what happens is if you leverage too much, a lot of agents will say, well, the cost of the insurance, if you manage the net amount of risk, becomes very little, but that's not the big cost in retirement. Big cost is the loan charges working against you. So,
and it also can become a big cost when you have those down years and you're older, right? That net amount at risk can spike and get out of control.
For sure.
And then you'd have to lower, maybe you could lower the death benefit, but now you're killing more of your income throughout your retirement. So
right.
It
So
just kind of defeats the purpose.
Understanding what I know, I would actually say this was kind of poorly designed, because if we look at the numbers, let me point this out real quick before we get down there. Remember, I told you she told me the riders are free. Riders are optional and may not be available in all states. Availability is subject to underwriting review, and there is an initial administrative fee at the time the rider is exercised.
Yep.
So there is a fee, and as you saw, when you exercise 100%, you don't get $400,000, right? So
right, you got the 346.
Here's some more stuff in the riders. There's the 10-year, that guaranteed flex rider.
Okay, yeah, and there it says will not lapse in the first 10 policy years. That doesn't do anything for you guys. The problems are not in the beginning years of the policy of IULs.
So the requirement is $206.50.
Okay.
And then there's the overloan protection. So you can see the policy had to be enforced for 15 years, and the insured has to reach age 75.
Right.
So if the policy were to lapse at 72, 73, 74, they would have to pay taxes on all the growth. And that's beyond what they pay in, right? So
sure,
your premium doesn't count towards that. This was actually pretty cool. Coverage under the combo multi-choice rider, so that term rider, that 200,000, may be converted to a new policy on the life of each rider insured. So you can basically take that 200,000 and start another policy, which I actually thought that was pretty cool. That's a nice feature. But let's go ahead. There's a bunch of definitions.
Definitions. Yep.
Let's see.
That's the lifetime income benefit rider.
Yep.
Talked a lot about that.
Yeah, we think we already hit on that pretty.
Yeah.
No need to beat a dead horse. There's
Hopefully
the
people got
US.
the point.
There's the US pay setter, so you can see the actual performance versus what they show you on paper. I circled this, so this was something. So the actual credit rates will vary based on the actual change in the index and actual declared cap and participation rates within each index segment. These features do not represent actual interest, but would have been credited because the cap rate and participation rate would have changed over time and the results would have been different.
Right.
Notice in all the other wording, it said they may change. Read that again. These figures would have changed. They're saying they would have changed by then. They're basically guaranteeing they're going to change things on you. And actual results would be different.
These are numbers that don't exist.
And then that's the whole point of why I circled that. The whole illustration is all BS.
not to mention, real quick, scroll back up for just a second.
Yeah.
These are gross numbers as well. Because when you read, there's an expense charge, policy fee, cost of insurance, other charges associated with the IUL. Look at this. The historical returns by this strategy do not reflect these policy charges. Guys?
Correct. Correct.
So, Michael, I assume we're about to see like the actual the tabular detail in a second here.
Yeah.
But
the only thing
not only do we have an illustration that shows credit every single year on a product that is based on the performance of the stock market, they're gross numbers. They don't even include all of the fees and charges as well.
Yeah.
Guys, that is going to have a massive impact on what you on your actual cash value over the long run. It's not going to be anywhere close, most likely, not going to be anywhere close to what the illustration is showing.
Not to mention, my particular index is a negative performing index.
So that doesn't help either.
That I got placed in, right? They're going to show 6.2 or 6.42%. This is another big thing right here. Your caps. So this is the S&P. Remember I told you, you always want to go with the S&P. Current cap is 9.25. But look at the guaranteed cap. Any given anniversary date, they can say, hey, we need to drop this to 3.1.
Right.
And remember,
which to be fair, they haven't done. That would be kind of a worst case scenario, right?
Right. But what some of these companies do also is they will actually show you higher illustrated rates on the new business. Mm-hmm. Meanwhile, the clients that are 5-7 years in,
right,
they have a completely different rate, and it's
right.
always
I've seen that. Yeah, that's wild.
So one of the worst. I've seen F&G is probably one of the worst at that. They have a big spread. Some of the companies have like 2%. So I'm actually not sure if NLG, practices this kind of thing. But this is why you have to look. And in my video, you have to look at the financials of the company. Mm-hmm. Make sure you're with a good, strong company that doesn't have to pull those levers on you. Because if you look at a company like an F&G, they actually have more liabilities than they do assets, right? And it's kind of like that rule, you could look it up, Google it, wow. Go into the assets versus liabilities. Their ratio is under 1.0.
That's crazy.
And so you have to ask yourself, like, if they are not taking care of themselves, it's kind of the thing, right? Like you wouldn't give your money to your broke friend, right? So why would you give it to a company that has proven they're going to pull these levers, has proven that they haven't managed their money properly? They still have more liabilities than assets. You want to at least look for a strong company if you're going to get into one of these.
And right? You know what? If these things are so great, why aren't they buying them so they don't have more liabilities than assets? Right? Maybe they should buy their own IULs, and they won't be in that situation.
well,
right?
well, common sense says you can't pay yourself and make money.
I guess. So then the other thing though is so the max illustrated rate here that we're going to see is it's 6.42% on these illustrations.
Yeah. So
Okay.
imagine you couldn't even get that.
So right. So there's a reason that it's a max illustrated rate. You got AG AG 49 a bunch of times, et cetera.
Right.
But it goes back to a point that I made earlier is, guys, is the extra few percentage points in potential, but I'm going to put that in very big quotes, okay? Is the extra couple of points in potential growth worth the risk? That's a question only you can answer. For me, it was an absolute no, because whole life policies set up for high cash value will net 3 to 5% on average, not to mention the tax benefits as well. Is it worth the extra few percentage points? I don't know. You got to make that decision. But to me, there's not enough extra potential growth here to justify the risk. It's just not there. If these things were actually performing at, I don't know, 8%, 7, 8, 9%, whatever, maybe there's an argument for that. But I haven't seen it.
Well, you can't really perform at 8% when you're capped at 9.25, right?
9.25, 10 and a half, 11, whatever it is.
Yeah,
not to mention all the charges. Again, that's a gross rate too. That's gross. That's not net of fees and all the charges too. So
right. So if you look at
I don't see it.
If you look at the pay setter, Matt, we have 235%. So that's why they show you this really high rate. But even 235% participation on 2 to 4%, it's really still like 4 to 8%, 4 to 9% maybe. But then they can drop that all the way down to 50%. So that's almost like a 78% drop right there in how much they can give you. And if you're there, I mean, put it this way, if you have a bunch of loans out and they drop this cap rate on you, nothing you can do about it. You're gonna have to 1035 your way out.
Yeah, for sure. And right. I want to point this out really quick. The last sentence in that first paragraph, right below the numbers, okay? It's saying the maximum illustrated rate for the indexed loan account is capped at 50 basis points above the current fixed loan interest rate. So they're showing 50 basis points of arbitrage, right? If they show income, and I think you said that she didn't show income on this particular illustration, right? But
she did.
Oh, she did. Okay.
Yeah.
Well, that's gonna be fun. It's showing 50 basis points of positive arbitrage. What happens when that doesn't occur, guys? What happens when you have a 0 year? Is it going to look as good as it does on the illustration? In reality, is going to be as good as it is on the illustration? No.
Yeah. There's two pages you don't see here. So the one page you only see on the policy is the maximum cost, right? So there's a table on the policy. Once you receive the policy, it'll say this is what the insurance will cost each year per 1,000. Right. So, and every year it goes up, and you don't get to see that, unfortunately, until you get the policy.
Really? I didn't know that.
Yeah, it's not. Yeah. It's not.
No, you're right. Because I did a video on that, breaking down an IUL from I think it was Transamerica, and but that was an in-force policy at that time, and it had that chart, and it was nuts, absolutely crazy how expensive it gets per 1,000 from when you start the policy.
Yeah, and the other thing that we don't get to see is an agent's not going to show you the expense chart normally. Most agents won't, and this one didn't come with it. So, but you can see how the borrowing the cash value does affect the policy, just in the way the values go down, right? So, but unfortunately, we don't have the actual numbers with this.
And you know what's crazy about this? So right there, it says U.S. Paysetter Index point to point, no cap. Current illustrated interest rate is 6.42%. Well, if it did the 13, 15% or whatever looking back, if it actually does that, why are we only illustrating it at 6.42%?
Yeah.
That's a pretty big gap. That's a big difference.
Well,
Is it maybe because it's most likely not going to do that? I don't know.
Yeah.
Maybe.
I mean,
probably not.
We pretty much proved that that's not the case. So
Yeah.
Yeah.
Should not be considered a representation of past or future performance. These okay, well, that's pretty standard non-guarantee.
Yep.
Legalese there, but whatever. All right, now we get into the numbers. Yeah, this is I love this stuff. I love the numbers.
So here's the guaranteed illustrated rates. Illustrated loan rate 5.9%. So if we did not get any interest, I believe the bonus on this policy is actually about 2%. Can't remember, but you can see not a lot of my money is going into the cash value. So that's why I said the agents that know how to structure these, they're going to get a lot more into that accumulated value. Meaning a lot more of that money is going to go towards your cash value growing versus the cost of insurance.
Right.
If you look at my surrender value, I have 0 my first year. In fact, even my second year,
and that means you have nothing to borrow against in the policy. You can't borrow against this at all.
Right.
Because what you're able to borrow against is based on the cash surrender value there, not the accumulated value.
Right. And I had actually highlighted that and then we didn't cover it. But if you look up here, it might be too far to find, but there's a surrender charge. And unfortunately,
which most IULs have, right? Unless you have a rider that gets rid of it, which you pay for the rider.
Right. And so there's a surrender charge in IULs, and believe it or not, I mean, a good IUL agent will disclose that and explain how that works. That way there's no surprises for the client. But
sure,
believe it or not, I've come across clients that they had no idea there was a surrender charge. The agent did not disclose this to them.
That's unacceptable. That's a pretty basic thing that you need to go over.
Right.
With the policy.
So
they need to
out of the 6,000, there's none available to borrow the first year. Out of the 12,000, there's none available the first 2 years. What that tells me is basically you take that accumulated value and you minus the surrender charge, and whatever that equals is what's available. So what we can determine is that surrender charge is more than 55, 53 in year 2.
Right.
In fact, it's probably closer to like 9,000, because in year 3 you can see 82.46, and then the available amount is 694. So that surrender charge is almost $8,000 at this point still. Right. So yeah, very important. When you're talking about
it's not a huge issue if you're not going to surrender the policy, but if you're also structuring these for cash value and you want to be able, like if you're going to use it for infinite banking or something like that, you can't have a policy where you don't have access to anything for a pretty long time. That's not good.
Right. With a good whole life policy, you can have it structured. The best I've seen, depending on how much money they could put in, like 94% liquid.
Yeah, that's what I had. I think mine was like 87% when I set mine up. Yeah, it's like 87 to 90% I had access to within the first 30 days.
Yeah, I just had a client drop 120 and he was 90% liquid.
Yep,
right away. Yeah.
Yep.
So, but yeah, number one, this policy doesn't work for infinite banking, because I think agents talk about infinite banking strictly as positive arbitrage, but it's also about having control. And so when you understand all the variables that you don't have control of, you actually start to realize that this is actually the opposite of infinite banking. You have zero control. Right. You can get positive arbitrage, but you don't have any control over anything. So,
well, and I would argue that infinite banking is not about positive arbitrage, at least not from the standpoint of the policy itself. Like, we're not trying to set a policy up to borrow at 5% so we can earn 5.5% in the policy. Right. That's ridiculous. That's not what we're doing. That's not what we're doing here. The positive arbitrage comes from how you utilize the policy. So if I borrow at 5.5%, which I've done, and then I do a private money deal at 12%, or if I'm flipping heavy equipment right now, like forklifts and stuff like that.
Right.
And if I make 15, 20, 30%, but my interest cost was only 5.5%, that's where the arbitrage comes in. That's how the infinite banking concept works. It's not trying to get positive arbitrage in the policy.
Right.
The policy is just the vehicle that we use to do those things, those types of things that I just explained.
Right. It's the and asset. And the reason you want to put it here is because let's say one of those deals goes bad and you end up in bankruptcy, your money's protected in the life insurance policy. It's not
going to continue to grow.
Right. Right. So yeah, it's a powerful concept, right? But you got to use the right policy. And when it comes to control, the whole life will give it to you and IUL won't.
Yeah.
Right. So
these are the guarantees. I'm curious to see that 6.42%. Yeah, and the guarantee is showing the lapse. That 0 right there, that's at 66. That's a lapse, right?
No. So that 0 is there's no more premiums being paid into this policy.
Right. Okay, that's premium. My apologies.
So if you want to see how much the cost is, you can see from 65 to 66, even with a 6.42% growth, we still drop down $6,000.
So this one's illustrated at the.
Sorry, this one doesn't have the growth. This one.
Yeah, this doesn't have the growth. The 6.42%.
So you can see what this costs right here.
But again, like you were saying earlier, this is the absolute worst case scenario where you're not getting any credits. This is not going to happen. So this is kind of useless.
Right. You could see it would lapse by 72.
Yeah. Right.
Right.
So anytime someone's telling you there's guarantees in IUL, it's useless.
Yeah. Not a good guarantee.
No.
So here we go. Here's the one that you should be looking at. I would tell you, look at the 3%, the middle column, right? Not the guaranteed column, not the 6.42, but the middle.
Okay.
However, when we show the income, it's going to be based off of the 6.42. So we could see that's going to grow to $238,995. And then that income rider, she turned it on for me. Well, it's about $9,000 a year.
9,000. Yeah.
Yeah.
The problem is,
by the way, did you see the death benefit once I turned that rider on?
Yeah, it collapsed. So from 600 to 283.
Right.
So it's basically factoring in all of the policy loans that it's going to need to take over the illustrated time frame at that amount, at the 9,000. Like it's doing that. It's calculating that ahead of time. And that's how they're able to guarantee it for life.
Right. They're basically turning it into an annuity.
Right. They're annuitizing. They're basically annuitizing the policy.
Yeah, it's pretty much following the 4% rule, right? You got 234,000. You're right about 9,000. It's about 4%. So
yeah,
nothing extraordinary, right?
No, but I mean, an extra $9,000 a year, if that's like a supplemental income, could be a nice check, whatever, nice vacation every year. My problem with this, like I say with every IUL illustration, is it's a stock market type of based product that's showing growth every single year. That's not going to happen. And so when it shows you turning that income rider on, okay, and at that point, what was your surrender value? The cash surrender value at 238,000 is your accumulated value.
Mm-hmm.
Okay, but what happens when you have a 0 year?
That's assuming we get lucky, right? Like,
well, lucky from the standpoint of the stock market going up every single year. Yeah, and I consider myself pretty lucky if that happens.
And the insurance company allowing you to participate in that stock market.
Yeah. So, You know, it's just it's a very misleading illustration. It's one of the biggest issue I have with these illustrations, and why actually like you said, the like the 3 to 4%. Okay, if I'm looking at an IUL illustration there, 3 to 4%. All right, maybe I can get behind that. But like when I see 6, 7, 8% every single year, and your cap is 10.5% or even 12%, and that's not even net. Come on, dude. Who are we fooling here? Like,
Right.
and look, if I'm wrong, please, guys, drop it in the comments. I'd love to, if you've got a policy that has been in existence for a long time. I'm not talking about 2, 3, 4 years. I don't care about that. I'm talking about 10, 15, 20 years, whatever. And you're actually averaging 7, 8% net. I'd love to see that. I'd love to see it.
Yeah, and I want to
But
point.
I don't know that it's out there.
I want to point something out. We've paid $6,000 into this policy for 25 years. So we're talking about 150,000 that went into this policy. We didn't even double that money over 25 years.
Yeah, and you're only at 238.
And once I turn this rider on, I don't have the living benefits. I don't have the coverage. I don't have the critical illness rider.
Right.
So when you're looking at it as an investment, dude, we could have doubled our money somewhere else.
Is it worth it?
Like it's not even, not even worth it.
Nah,
and that does
not to me.
That's 238. So we didn't, number one, we didn't even double the money, but then we have loan costs on top of it. So it's not even free and clear money.
Right.
But
that's crazy, dude.
And you still got this. There is a charge for the cost of insurance and other expenses in years when no premium is paid into the policy.
Yep.
That's, like I said, she told me I could pay it up in 15 years. This just told me I can't. I can pay no premium, but there's still a cost of insurance and other expenses in those years I'm not paying. So
yep, because it's built on annual renewable term, guys.
Mm-hmm.
That cost of insurance never goes away.
Premium payments, which may be greater than the initial premium, may have to be resumed to maintain the policy in force. And
that would be nice in retirement, wouldn't it?
I've seen this, Matt, where not for IUL because they really haven't been around long enough for someone to pay into it 30. They just haven't been around long enough for someone to pay into it 30 years, and now they're in retirement. But IUL is just UL with an index, an option strategy attached. And I have seen universal life policies, which their crediting strategy is based off the mortgage rates.
Right.
I have seen clients where the insurance company is coming to them like, hey, you got to pay more if you want to keep this policy. And because that rate does continue to go up, it's really just a losing battle. It's a matter of time before they're going to price you out.
Yeah. Most people just let the policy go at that point.
Yeah, for sure.
It's a shame. And, at that point, you lose your coverage, you lose all your benefits, you lose all the money that you put into it. Could have a massive tax bill potentially. So,
yep.
Well, no, I guess I don't. Maybe you'd have a massive tax bill. Maybe you wouldn't. But either way, not a good scenario to be in.
Yeah, we fast forward. You can see the cash value running out here in both columns, right? It never actually runs out because remember it has the rider, so it's
the rider
never going to lapse. But if this was without the rider, this policy would have lapsed, right? If you were, just imagine 500,000, you're paying 5.9%. You're already losing 13,000 from this year to this year, right? 143 down to 130. Imagine adding additional, 35,000 in loan costs.
Right.
Right. You already dropped down a few years down to 90,000. So, it's just a matter of time.
Yeah, so I guess there would be an argument for the lifetime income benefit rider to make sure the policy doesn't get over leveraged. It doesn't, and you reduce that risk of it lapsing. But at the end of the day, it comes down to how much risk do we want to take for this potential upside potential? Kind of redundant there, but you know what I'm saying. Like for these extra couple of percentage points of potential growth. I don't know. Look, guys, at the end of the day, read the fine print, know what you're getting into, and then make a decision. Maybe an IUL is good for you. I don't know. You see something I don't. That's for sure.
Like I said, only if you're looking at it from two angles, right? As an investment or an insurance policy. As an investment, it doesn't grow very well. Like it can grow better, but it can be structured a little bit better with the cash value. But you can see, like in this policy in particular, it didn't grow very well, right? And then there's still costs, so it's not a great investment. And then from a insurance product, there's no guarantees, right? We could have just bought a term for 35 years and had that coverage, for $30. So,
or what we could do is we could get a whole life product that has an indexing option rider, which does exist. So if you want the upside potential of the market with the downside protection, but without all the issues of IUL, that exists. It's built on a whole life chassis.
Yeah.
And the only thing you risk at that point is your dividend, because they use the dividends to purchase the call options, but you still have your guaranteed growth rate as well. There's no cap rates or participation rates or anything like that we have to worry about. No rising cost of insurance. It's just they take your dividend, they buy the call options with it, just like they do in an IUL. And depending on how the market does, if it does 10% or more, they double your dividend. If you do 5% or in that range, they just give you whatever the dividend would have been. But if the market goes down, you just lose your dividend. But your policy still grew by whatever the guaranteed rate is, which at this time it's 3.25%. So
there's a couple options, Matt. So that is one option with one of the carriers that I use. I know we both use it. Another option actually just has a 4% floor with a 10% cap, which is what these companies are getting anyway. So that 4% floor basically guarantees that, hey, I'm still going to get the dividend, right? So
interesting. I'll have to learn more about that one.
Yeah,
because these aren't very common right now, right? Like they're still somewhat new on whole life products. Because usually, I mean, whole life, it doesn't have anything to do with the market, but these are kind of newer riders that they're coming out with right now. Yeah.
But the big key is it doesn't affect the guarantees in your policy.
Right.
And I'll share a story. I have a client. She actually just gave up her IUL. Had she had a whole life, she could have called the insurance company. She got in some trouble with some debt and stuff, and she's like, I just can't make the premiums anymore. And, I feel like I just want to take the cash value and cash out. Had she had a whole life, she could have paid it up. She could have called the insurance company and said, hey, I can't make any more premiums. I want this paid up. It could have kept growing. They would have just reduced the death benefit and there would be no extra charges going forward. She wouldn't have to worry about it. But in the IUL, because there is the charges every single year, you can't pay it up.
Right.
She couldn't do that.
Yeah.
So
that's frustrating, man.
Yeah.
Yep. At the end of the day, it just comes down to, knowing how these things work. Guys, please do your research. All right. Not saying everybody needs to do whole life. Not everybody needs to do life insurance in general. Like, you just know what you're putting your money into, because these things can have massive financial consequences later on down the road if you don't know what that fine print is, like all the things that could potentially go wrong. Once you do, you want to pull the trigger, fine, go for it. You're an adult, do whatever you want with your money. Okay. But a lot of times people don't know what they're putting their money into. And that's the biggest issue I have with this. So with that said, we'll go ahead and wrap up. I think we're at an hour and 45 minutes, man, long training, but that was really good stuff. I think, breaking down the actual illustrations and going through the fine print, all the things, and just explaining how the product actually works. I think I don't know. I think it's very beneficial. What do you guys think? Drop some comments down below. I'd love to hear your feedback. But I think that was really good. I appreciate you sharing that with us. Any final thoughts that you want to share with people?
Yeah, I mean, just know what you're buying. If you have an IUL, don't hesitate to reach out. Have us double check it. There are certain riders, and like I said, like, you can have some money back guarantees in certain ones. But yeah, you just got to be aware of what you're buying. And unfortunately, in the industry, it's there's not a lot of transparency around this product. It's being sold on all this hype.
Yep.
But nobody's telling, like how it actually works. Right. So, yeah, just take your time, learn, watch these videos, watch, Matt's channel, watch my channel, watch, Chris Kirkpatrick's channel, Life 180, get all this information. It's out there. You just have to go and find it.
Yeah. And yeah, I totally agree. And just to add one thing to it, it's like there's so much conflicting information out there as well. It's like it's imperative that you listen to both sides so that you get all the facts and the information and then make a decision. Because like Michael said, like there's so much crazy stuff out there. You're on TikTok. Like I can't believe some of the things people are talking about on TikTok with this stuff. It is egregious. But just be careful, guys. That's it. At the end of the day, please just be careful. Do your research. All right. And then, make the best decision for you once you understand how these things work. Right. So that said, we'll go ahead and wrap up. Michael, it's been a pleasure, man. Can't wait to do more of these. I think it's going to be a lot of fun. We got some good stuff planned. So make sure you guys subscribe, and we'll talk to you in the next one. I appreciate it, Michael.
Appreciate it.
All right, man. Bye.
Bye.